Hello and welcome everyone to this weekly market recap. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com. It's a pleasure to be with you all again for this weekend. It's been an interesting week. This is the week we normally see action to the upside. It's the Santa Claus rally, right? Unfortunately, nobody told I don't think there was any message sent, no text message or whatever to Wall Street today because obviously Friday we did not have a very good day. We'll take a look at that in just a minute. But what I can tell you though is if we look back over the last week and you look at this chart list, this is just of all the key indices, you'll see that the 6 indices that I like to follow, transports, NASDAQ 100, S&P 500, S&P 400, the Dow Jones, and the Russell 2000 for the week. This is for a 1-week period, all up. So I guess the Santa Claus rally lives on, but it didn't feel much like a Santa Claus rally after today, Friday, December 27th, because we did see a lot of selling, and we'll take a look at that just so you can give you, maybe you don't want a reminder. I don't really want a reminder either. But it wasn't a great day. You can see the Dow down 0.75% or 333 points, back down below 43,000. S&P 500 dropping more than 1.1%. NASDAQ down almost 1.5%. Although the Mag 7 didn't do as badly, so the NASDAQ 100 actually held up a little bit better than the overall NASDAQ, dropping 1.36%. Small caps down 1.33% and mid caps down almost a full percentage point. So you can look at these numbers. You see a lot of red today. But again, for the week, we were actually green. So we had a pretty good week going until we saw things reverse today here on Friday. Volatility, though, was higher. That's never a good thing. We saw an 8% jump. Remember, I mean, volatility has been crazy this month if you haven't been watching it. We normally don't see a lot of volatility during the month of December because December is historically a bullish month. And so usually we're looking at higher prices, especially the second half of December. So we normally don't get the kind of down days in December that would produce a gain in the VIX of 8% or more. But hey, 2024 coming to a little bit of a surprising end, I guess, based on some of the selling that took place today and the VIX jumping 8%. I will say I get much more nervous with the VIX above 17 and especially above 20. So we are down at, even with the 8% gain, we're still hovering around the 16 level. So I'm not quite ready to write the market off because of today's poor showing. But I do think that the volatility has been more than what we are accustomed to in the month of December. Taking a look, I wanted to pull up this MarketCarpet. There we go. So the S&P 500, when you look at the S&P 500 and the stocks that make it up, you can see why the S&P 500 had such a strong year. It's market cap weighted. And so the size of the boxes that we look at here indicate overall percentage of the stocks that make up the S&P 500. So Apple's a huge component of the S&P, and you can see Apple's up 38% this year. So when you're heavy, your heavy market cap weighted stocks are performing well, that is going to help drive the stock market to the upside. So seeing Meta up 74% or Amazon up 49%, Tesla up 73%, Google 40%, Microsoft 17%, Broadcom 126%, Nvidia another 184% this year. I mean, we think, anybody who's been watching Nvidia he probably thinks it didn't have a very good 2024 because since about June, July, Nvidia has been struggling. It's been going mostly sideways. But that's to ignore the first half of the year when Nvidia absolutely exploded to the upside. But I think this is just a real good reminder of what's been driving the stock market to the upside and why the S&P 500 has had such a fantastic year. But this market carpet, I think, is pretty cool because we can zero in. For instance, I'm going to show you consumer discretionary. And some people like me think that this is awesome. When Amazon and Tesla has a great year, generally it's going to mean the XLY does well because there's such large components of the XLY. For those maybe who don't look at just the large cap and the market weighted stocks and look at all of the stocks in the XLY, you see a lot of red in here. So it's, kind of easy to understand why some folks are nervous, and maybe feel like the XLY isn't a true measure of how discretionary stocks are actually performing. When you look at this chart, you can see a lot of red. And this is year to date change. This isn't just last week's change or last month's change. This is year to date. So while the market may have had a super 2024, there's a lot of individual stocks that did not participate. Not only didn't participate, but actually went the other way and were giving back some during such a strong year. I get it. You look at this and you say, well, it's just not, we're not seeing the strength everywhere. I look at it and I say, well, Amazon and Tesla are pretty important companies to our economy. They employ a lot of folks, especially Amazon. And so it's kind of a good thing for our economy when that stock goes higher, in my opinion. So I don't want to lessen Amazon. I don't want to treat, if you use an equal weighted consumer discretionary ETF, you're going to weight Amazon, which is this huge component, versus maybe, inspired entertainment, which is down 8.53%. I mean, do you think it's right that we should treat these two stocks the same? I mean, to me, it makes no sense, because Amazon, again, is such a massive part of our economy. And until today, I don't even think, well, actually, IGT, there was another one I was looking at. Where'd that other one go? Yeah, Inspired Entertainment. Honestly, I don't even remember seeing that stock before. It's not one that I follow or have ever that I can remember looked at. So again, you're looking at equal weight. You're saying these two companies represent basically the same thing. And so therefore, you wouldn't want to be in discretionary because one's up, one's down. Well, I look at it a little bit different. I think Amazon is obviously a much, much, much more important stock, not only for the XLY, but also for the market in general. But you could play around with that market carpet. If you go into your dashboard and you go down here to RRG, right above that, so it's under the charting tools area of member tools. There's your market carpets, and there's so many ways you can look at this. Go in here and let's pull it up, because one of the things you can do is break down technology. Here's the XLK. Oh, this is a one-day change, so a lot of red here. That's why today wasn't such a great day. But if we do year-to-date change, it shows you what's going on within the technology group, right? If we look at, let's get out of there. Let's go back to the S&P. I mean, one of the areas, oh, there's the back button. Another area is financials. I want you to look at financials. There's not a lot of red on this chart year to date. All the companies that make up the financial group don't really see a whole lot there. And if you break down financials itself over here, then you can look at individual areas within the financial sector. Look at the banks. There were, a handful of stocks didn't perform well in banks, but for the most part, banks, pretty strong area of the market. Anyway, I just wanted to point out that market carpet. I think it's a pretty cool feature on Stockcharts. If we look at the sectors over the past week, just about everything was up, mostly near the zero line. I mean, we did see a little bit of strength in energy and healthcare. Healthcare hit a key important support level going back on that XLV. So if we pull that up in a sharp chart, and then let's look at the weekly chart. You can see that we went sideways for quite a while, and we came back down, and we had this support area between 135 and 140, and we were just testing it. So we kind of bounced off of that this week. So I'm not shocked by that relative strength that we saw there. I do want to point you over to our website at earningsbeats.com, because we have, I think, the biggest event of the year, certainly our biggest event of the year at Earnings Beats. Next Saturday, January 4th, it'll start at 10 a.m. Eastern time. So if you go over to earningsbeats.com, you will see this link here that you can click on, and it will bring you to a landing page which talks about the event. I'm calling it the year of diverging returns. I'll talk about that more on Saturday, next Saturday. But one thing I want you to be aware of is if you attend this event, pay for the event, you get a free annual membership with your registration. And our annual membership is more than the cost of the event. So pretty good deal to register, come to the event, and then just get a free year of service at Earnings Beats. So I wanted to point that out. Yeah, I'm going to come back, I think, with my boldest call ever. I got to see what happens in the market over the next week or so. Market's trying to change my mind. I do want to mention that I got a great guest joining me on Market Vision 2025. That's Dave Keller. Many of you know Dave from Stockcharts. He's been a colleague of mine, written alongside me for a long time, does videos on YouTube. Also, his Market Misbehavior podcast. You can check that out. But Dave, a really good friend of mine, really looking forward to his presentation. He's going to be giving some scenarios, how he thinks 2025 is going to start. He'll give you different scenarios and why he thinks it could go different ways. And then he'll give you his thoughts on which way he thinks it's going to go. But he's going to be joining me for the event. And I do want to point out that we've been doing this now for the last 5 years. And in 2020, I said the market was going up at the beginning of the year. And of course, then we had the pandemic, and that couldn't have come at a worse time. But you know what? By the end of the year, I thought we were going to go to 4040. We got all the way back up over 3,700. So pretty solid prediction, even with a pandemic in the middle of the year. 2021, I just said I thought we were going to go up 1,000 points. 3,700 to 4,700, we closed in the 4,700s. 2022, we started the year. I said first 3 to 6 months, we could see as much as a 20 to 25% decline and a cyclical bear market. That's what we saw in 2022. 2023, again, I thought we'd close back up near the 4,700 level. And what did we do? We closed in the 4,700s. 2024, I predicted the market to go higher, but it was probably my worst prediction because I wasn't bullish enough. So for those of you that think that I'm just always crazy bullish, I wasn't bullish enough in 2024 to start the year. I was probably one of the more bullish folks out there, analysts, as far as, taking a look at where we were at the end of 2023, basically testing all-time highs. A lot of folks thought that was a double top. We were going to go back down. I thought we were going through and we are going to have a nice solid year in 2024. We actually did better than I thought. So, and part of that was presidential election year usually sees a lot of weakness, August, September, October. We didn't really see that after the August 5th low, following that Fed meeting at the end of July. August 5th on, market just completely moved back to the upside. So here you can see that August low. Also, if you're on your mobile device, we've got a slide up right now. You can you'll see a QR code. If you scan that QR code with your phone, you'll move over to the landing page so you can sign up from your mobile device as well, trying to make it as easy as possible for everyone. All right, so I want to talk a little bit because I just said, 2022, we had that cyclical bear market that I predicted. And there's a lot of folks thinking 2025 is going to be maybe not such a great year, and that some of the selling we've seen in December is kind of a precursor to that. But I want to first just talk about this December move right here. So we did go down the daily chart below some key moving averages. We bounced back. Now we seem to be rolling over. And if you look at this, I'm seeing a potential head and shoulder top. Here's the neckline. Here's your left shoulder down to the neckline. Higher high puts in the head, back down to the right side of the neckline. Here's your right shoulder bounce. And now we're starting to, or are we starting to roll over here? Is this going to be a head and shoulder breakdown? I think, we got a lot more, action on the chart that has to take place. And this pattern is not bearish until it executes, by the way. So watch that neckline, and then also watch the gap support from just before the election. That's down at about 5,800 or so, maybe just below 5,800. If you see it, if we're trading back down at 5,750 or maybe even lower than that, and that's only a couple hundred points away, by the way. I mean, we're talking about 3%, 3.5%. I'm not talking about a 15% drop. But if we take that drop, it could open up for some more selling as we go forward. All right, so what I want you to focus on here, this is an RRG chart. It has all 11 sectors on it, but I've highlighted over the 20 trading days that we've had so far in December of 2024. Look at what the key aggressive sectors are doing. They're on the right side of the chart. So if they're on the right side of the chart, it means that they're showing relative strength. The market's been rolling over and going down. Normally, what we see are these aggressive groups getting hit harder when the market starts to struggle. And especially with everybody out there talking about, inflation not being done yet, that we may have inflation problems going forward. There's another camp that says, hey, we're uninverting the yield curve. That could lead to a recession. Both of those scenarios would suggest to me that these three sectors need to be over on this side of the chart. They should be underperforming. If you're on Wall Street and you're expecting inflation or a some kind of a recession, minor, whatever, you would be getting out of these groups on a relative basis, not into them. And so I question that. I want to show you what happened back in 2021. You remember in 2021, we had a big up month in December. We went to an all-time high. As we started January of 2022, we were at an all-time high. Do you know what was happening in December right before that? This is what was happening. These same three aggressive sectors were on the left side of the chart. Market's going up and money's rotating away from these groups. That's completely different than what we're seeing right now. So I'm just going to ask you this question. First of all, if the market's going to go down, Wall Street isn't going to be shocked by it. Wall Street is going to prepare for it. That's what they did in 2021. They were moving out of the aggressive areas and moving into the defensive areas before that bear market started. If you look at where we are right now, go back to that chart, I just don't see it. I don't see the rotation into, away from aggressive groups into the defensive. All the defensive groups are way over here. They've been getting killed. A good hedge against inflation is real estate. So if inflation is still a problem, or maybe it's going to be a worse problem in 2025, why is real estate getting crushed on a relative basis? Let me pull this up. Hold on a second. Let's go down and take a look at real estate. So here's real estate. I mean, throughout December, it's just getting worse and worse. It went from the improving back down to the lagging, and relative strength just keeps pushing further and further to the left. Things couldn't be any more bearish right now for real estate. Does that look like markets preparing for inflation? I mean, you can ignore these charts. You might think, hey, this doesn't mean anything, and that's fine if that's your opinion. I think it means a lot. I think it tells us a lot of what's going on underneath the surface to help us predict what the market may do going forward. And I'm just not seeing the bearishness. I mean, yeah, we've had a couple bad days. We always have a couple bad days. I mean, market's not going to go up every day. It's not going to go up every week, every month. We're going to have periods of pullbacks. Those are opportunities in a secular bull market. All right, so next thing I want to do is show you a relative chart of the XLC, or an RRG chart of the XLC. These are the components in communication services. And here is I wanted to point out two stocks. One, which is LYV. This one, absolutely the furthest one over to the right in the leading quadrant. So the relative strength is awesome, but it's been slowing down. The momentum's slowing down, and it's about to turn down into the weakening. And when you look at the LYV chart, you see tremendous strength. And then over the course of December, we have been pulling back further and further, getting close to the 50-day, getting close to some gap support levels, getting close to what might be an opportunity to enter onto a stock, Live Nation Entertainment, that's been so hot in the latter part of 2024. So the pullback is, likely giving us a little bit of a heads up as to maybe a buy down the road, something to watch. But that's what the RRG tells me. Then I look at a stock like FOXA, which is in the weakening, but starting to rotate back in northeasterly fashion back toward that leading quadrant. And that tells me that it's holding up. It's starting to build a little bit of momentum. It's holding its relative strength. So while it's dropping or going sideways, it's been basically holding up with the market. It's not underperforming the market. And if I look at the chart, look at what, we kind of had a topping candle a little over a week ago, and we've just kind of been meandering a little higher, came back down today, just kind of going along with what the market's been doing. But that comes after a lot of relative strength. And so if we were to actually see a pullback back closer to that 48 level, we got the 20-day moving average, gap support, and a lot of other things coming up as well. Anyway, those were two I wanted to point out there. The other sector I looked at, or I wanted to look at here for you, was the consumer discretionary group. And you can see two stocks that have been coming out of lagging and improving and going straight into leading, especially this longer tail here on Lululemon. So you can kind of see when the longer the tail, the more push behind, the more momentum behind the move to the upside. And the more relative, well, in this case, going from left to right, it's a lot more relative strength. And so I wanted to look at these two charts for you and we'll wrap up the show. But here's Lulu. This is the big push to the upside. It's kind of holding its own, bouncing off the 20-day moving average. This has been a great performer coming off the recent low in August. I think the strength's been building. Price volume is looking a lot better. And of course, that RRG shows us that this is becoming a leading stock. Something to keep in mind when we get pullbacks. Same goes for Garmin. GRMN, that was a stock that reached a high back in the second week of December. It's pulled back a little bit, and that's why it doesn't show quite as much of a move to the upside in terms of momentum and all. But Garmin has moved its way back into that leading quadrant. And I think, again, you've got some really good support between about 198 and maybe around 205, 50-day moving average coming in at 202. Any kind of a pullback. Remember, we were just up over 220 a couple weeks ago. Now we're at 209. And a further pullback, maybe to around the 204, 205 level, would look really interesting on a stock like this that's becoming, an obvious leader. All right, that's it for me. I really appreciate everybody tuning in. As we go next week, it's going to be another holiday abbreviated week. We've got New Year's coming up on Wednesday. So Happy New Year, everybody. Won't be back doing another one of these shows until after New Year's. Please be safe. And if you're traveling throughout the holidays, make sure you get home safely. And we got 2025 to look forward to. So just wishing everybody a healthy and prosperous 2025 ahead. And I think to start that off, come join us for Market Vision 2025. Again, Dave Keller is going to be joining me. It's going to be a great event on Saturday. So make sure you come in and check that out. Have a great rest of your weekend and Happy New Year. Happy trading, of course, always.